Hey everyone, it's Shauna, the Tax Goddess and Chief Tax Strategist for TaxGoddess.com and BigTaxDrop.com, and super excited to announce that we now have DropMyTaxes.com, which is our third awesome website, so check it out, DropMyTaxes.com. Anyway, I'm super happy to be with you here today on our channel, Tax Strategies that Save Entrepreneurs Thousands Each Year. We're dedicated to helping business owners reduce their tax burdens in all the legal ways possible, and of course, I'm thrilled to be here with you. So today we're going to talk about the dreaded Kiddie Tax, K-I-D-D-I-E. No, unfortunately, it's not an income tax on cats, kitties, but little ones, children. So if this is your first time here with us at Tax Strategies that Save Entrepreneurs Thousands Each Year, please subscribe, turn on the little notifications button, and download our free ebook, 10 Ways to Save 10K right now. And of course, you can check out our websites, TaxGoddess.com, BigTaxDrop.com, and DropMyTaxes.com. So let's jump right into it. Let's jump into the meat of it. Random side note, remember to register for our webinar. We'll put the links down below. It's a webinar about these tax law changes that are happening, that have happened for 2018, moving forward all the way through 2025. So join us for the webinar. It is on May 24th, 11 to noon, Arizona time. Can't wait to see you guys there. So let's jump into the meat of it. So what is the Kiddie Tax, K-I-D-D-I-E tax? This is a way, or was a way, has been a way for the government to tax unearned income. So income that basically should belong to the parents, but they've shifted assets like capital assets or interest and or dividend-bearing assets to the children to attempt to get around the higher tax code rates for the parents. Under the new tax law, this income tied to the child's Social Security number is now going to be taxed at trust and estate rates, which is really bad and really high. So there are some ways to get around this kind of tax, just different ways to handle the same type of asset transfer from parents to children. So the first one is make sure that your kids' income, the unearned income, which could be capital stocks, interest, dividends, those types of incomes, are not over the $2,100 per year limit. So that really restricts the type of income flow that your kids, the kiddie children, can have, this unearned income types. So other ways to move assets to children, you could follow a gifting program. So you are allowed to move up to $14,000 per year per person. So if you have a child, you could, and two parents, you could move up to $28,000 a year to the child. Child could then do whatever they want to do with that money, put it away for school, lots of different options, which we cover in all sorts of different videos. The next thing that you may want to consider if you're trying to get money to the child is to pay them for doing a job for you. Actually give them earned income. I personally really like this option because, of course, with earned income, the child can put some of that money into a Roth IRA, a traditional IRA. If your business has a 401k, there's options there that the child can even defer some of the money that they've earned until they're 60, 70, whatever, and getting to retirement. So that's a great option as well. You can allocate, if it does need to, if the money needs to be in interest-bearing accounts, interest dividend accounts, you can move that money into municipal bonds. They're sometimes called munis, M-U-N-I-S, and typically the income on those particular types of bonds are completely tax-free at the federal income level. So there would be no worries about having interest or dividend income that's taxable that would cause the taxation and the Kiddie tax to hit. You could, of course, also utilize what are called tax-deferred investments to produce income growth. Those could include stocks, bonds, T-bills. There's lots of different options there. So really, if you're looking at your children earning more than $2,100, this is for the 2018 year, those rates do change. If they're going to earn more than $2,100 of this unearned income type, you definitely want to make sure that you are reallocating and making sure that all of the money is in the right place to pay the least amount of tax. So thank you so much for joining us here today on tax strategies that save entrepreneurs thousands. You know, we're always here to educate, entertain, and inspire. So hopefully we gave you some education today. For those of you with children who have assets, make sure you're watching out for that really, really nasty Kiddie Tax, Kiddie. And by the way, I'm totally tempted to put a picture of a cat on the cover image for this video today, just to grab some attention. I love it. Anyway, hope you guys are having a great day. Remember to register for our event upcoming. It's 11 to noon on May 24th, Arizona time. It is a webinar format live, so you can do live Q&As on the new tax reform changes. So super, super excited to have you guys with us there. Make sure you turn on notifications here on YouTube, you subscribe to the channel, and of course you can find us in all sorts of different places like our Facebook group, Tax Strategies That Save Entrepreneurs Thousands, our newsletters from taxgoddess.com, and of course our podcasts, Tax Goddess Live. Those things are awesome too. So feel free to connect with us in any way that you'd like and save yourself a ton of money. Come join us. All right, I'll talk to you guys later. Signing off with Tax Love, your tax goddess and chief tax strategist, Shauna. Bye.